Hello, everyone, and welcome to this week's On the Spot, where we break down what the most recent happenings in the freight market are. I'm Zach Strickland, Director of Freight Market Intelligence here at FreightWaves, and with me, as usual, JP Hampstead, Director of Passport Research. Welcome, JP.
Hey, thanks for having me, Zach.
So we've had a big week.
Yeah.
Another one, like the 26th in a row after the...
Yeah, so, I think the biggest news this week in terms of the data was just that the outbound tender rejection index retook an all-time high, leading into Q4, really still in kind of like a lull period before peak season truly kicks off.
I think that's what's interesting, is that traditionally October's kind of a softer month. We have this September where a lot of the shippers are pulling forward, getting ready for retail peak in November, December. The rails and the maritime get really active. And then there's kind of this lull period. 2 years ago, we saw a dramatic drop. It was basically what we called the end of the great freight boom back in 2018. Volumes fell dramatically. Last year, we had a little bit of a moderation. They didn't have a lot of room to fall, but this year, we didn't see that. This
year, they were pretty flat, and markets held their momentum. Spot rates dipped for a second, came back up. The national average drive-in truckload spot rate on truckstop.com is like $2.95 a mile. It's high for a national average, and that's including fuel, but still. Yeah. I think that's really the big story, is that even though it appeared maybe a couple weeks ago that things might cool off a touch, they never really did. And so, we fully expect those spot rates to continue to go up in Q4 as demand spikes again, as capacity is a little bit more constrained, with people trying to get home, maybe some bad weather in different places, things like that. I just think that this is as strong of a platform to leap into Q4 as we could have expected.
Yeah, I think that all the numbers look like you said, as strong and as sturdy. There doesn't appear to be much weakness. You look out on the ocean, imports are still flowing in. We came down a little bit off of August, September highs. You could call that the peak, but we have not retracted that much off of that peak flow, and we've got Golden Week that just occurred, and nothing really came of that. Now, October's Golden Week isn't necessarily as impactful as the one that happens in winter, the Chinese New Year, but still, there was almost no stoppage of flow. The ports are still very active. We've got Los Angeles still competing for capacity with Harrisburg and the northeastern corridors. They kind of have this tug and war going on. We have a hurricane.
A
major one about to hit Louisiana.
Delta, again. Right? We're now the Greek alphabet. Yeah. So everyone go back to school and go back to your fraternity house and try to remember your Greek letters. We'll see how far in that alphabet we get this year, because I think there's another depression actually further to the southeast in the Atlantic Basin. But Lake Charles looks like it's about to get it again, and thoughts and prayers go out to the Gulf Coast community. Obviously, they've had a rough 2020, and we've seen a little bit of effect, right, along the Gulf Coast. Higher tender rejections came down, like you said, I think earlier before we started this conversation, and then have now come back up as carriers avoid the area.
Well, we've done studies on this in the past. Daniel Pickett and his team has, looked at some of the telematics information and seen that carriers essentially they go in and then they come out, and they basically put up a radius around the coast, the impact zone, and they're poised. They're basically sitting there waiting for the hurricane to pass before they re-enter the area. And I think that's what we're seeing materialize in the tender rejection rate right now, is they're really basically avoiding going into pickup freight.
I wonder what happens to this area in terms of future freight demand for the rebuilding and reconstruction efforts, after a second, if a second hurricane comes through, causing an equivalent amount of damage as they've already seen. Does that create more freight demand later? Does it create less? Like, I saw some photographs that a meteorologist shared last night of Lake Charles, and there's still like just wreckage everywhere from the last hurricane. And to the extent that some buildings may be damaged, right? And now if they get hit by another, what do they, are they further damaged? It's hard to say. Like, does it lead to just people just not coming back, for an extended period of time? You know what I mean? Like, I wonder, like, what sort of this double dose of hurricane destruction, like, it does just for a rebuilding and relief timeline.
It sounds like you need to do some research for some hurricane impact on the freight market. I don't think that it's going to have as much of an impact due to the fact that the eye has actually shifted slightly. It's 15-20 miles forecasted, 15-20 miles further east this time, which again is a lot less populated area. Yeah,
so it's like the middle of nowhere.
It's swamp. I mean, it's a legitimate swamp. And again, fortunately, these hurricanes, I mean, Lake Charles, again, it's rough for them, but again, it is hitting areas where, are far better than like a Tampa Bay, or, if you're hitting in some of that, Panhandle of Florida area, Pensacola, that, all it's going to take, like, if these were to hit in some of these highly populated, very dense areas, it would be a complete catastrophe. And unfortunately, it's not. But, in terms of the freight market, since we are hitting low infrastructure areas, low population areas, it does tend to have a lot lower impact to overall capacity as we know it. But, we have, ironically, the hurricanes have not been the main story for freight this year. We have not really seen as much disruption from hurricane as we traditionally would. Harvey and Irma still fresh on people's minds. The freight market itself, though, has not needed any help from natural disasters. COVID's still driving a lot of these.
COVID-related disruptions, changes in spending. I mean, it's almost hard to like. I feel like in 2017, these hurricanes helped touch off a cycle that already had some underlying fundamentals supporting it, and they were just kind of like a catalyst.
Exactly.
And I don't feel like this year a catalyst was necessary. I mean, COVID was the catalyst, right? And so the hurricanes have been, had like sort of marginal impacts, but it's like throwing a lighter fluid on a bonfire that's already raging.
Yeah. Right? So let's continue on with this comparison to 2017-18 and those freight markets, because that's the last time we've had this kind of disruption in the freight market. Tender rejections being over 25%, volumes being a lot higher than they were the year before, coming off of a soft year into a hot year. What, carriers are obviously having a heck of a time trying to keep up with all this capacity demand, but the fact is that we're talking about in 2021. What is this going to do? I mean, you guys just did some research, and carriers are obviously, I'd like to break that down a little bit. I'd like to hear a little bit about how carriers have done this year and what has been a struggle for a lot of other industries.
I mean, April and May were bad months. So we just did our asset operators report, which we do monthly, and it's going out a little bit later today, and it just covers sort of like truckload carrier specific data. So a lot of times we do trucking markets that has to do with like rates and capacity, and it applies maybe as much as to 3PLs as it does carriers, but we really focus in on things like revenue per driver per week, operating ratios, equipment values, fuel spreads, things like that. And I mean, basically all signals are flashing green right now for truckload carriers. So revenue per driver per week is over $4,000. Empty mile percentages are down below 15%, in the 14% range, which is pushing operating ratios down to around 95%, and that's consolidated company drivers and owner ops.
Where were ORs in 2018? I mean, it took a while for carriers to really recognize some of these ORs, whereas we're seeing them effectively, drive those ORs down now.
They've just now gotten back to like 18 levels, essentially, and so that's great. The fact that operating ratios have been improving for months now, and carriers still feel like they have pricing power, is allowing them to reinvest in equipment, So we saw new truck orders spike in September to 31,000 units, which is above the replacement level, although that's coming after a really deep sort of trough in orders. So it'll take a while for that to really play out. We're also seeing used truck prices, the 3, 4, and 5-year models all move up kind of, simultaneously.
Right.
So that's, I just feel like the carrier sentiment is that the rally has legs, they're reinvesting, they're replenishing their fleets, things like that. We'll see, and even in some parts of the market, we're seeing driver wages go up. And I think what's really important now, there's still a lot of uncertainty with the progress of the virus, the macroeconomic picture, ultimately freight demand, fiscal stimulus, et cetera. And I just think that it's really important for carriers to stay disciplined, to focus on yield management, control costs to the extent possible. I mean, that's always true, but it's
when they get a few dollars in their pocket, the operation tends to get a little bit looser chasing that dollar.
I know, but I just think like now is like really a time to try to buckle down, stay disciplined, and be as profitable as possible.
Yeah, and we've had a couple of articles. I wrote one this past week about rate increases coming down the pipe next year. I did a very high level correlation between CAS, Truckload Line Haul Index, the PPI for long distance truckload, and OTRI, United States. So basically a very macro look at this to see what kind of impact that 2018 OTRI would have on the market. Looking at rejection rates in combination with contract rates, effectively. And it looks like, if things remained the same, that contract rates would go up roughly 4 to 6%, somewhere in that range, if it were all equal. Now, I think in 2017-18, we had a lot more, I think carriers were a lot more optimistic. What do you think about that?
I do. I remember going to industry conferences in 2018 and people talking about this very constrained and elevated market being a new normal. I don't really think that people are saying that now. I think there's a little bit less sort of irrational exuberance because of the uncertainty I just mentioned.
Right.
I mean, I think 4 to 6% sounds reasonable. I think when you have pricing power, you take as much as you can get, right?
Sure.
And so we'll see how that plays out, and we'll see just how contract freight is repriced as we move through.
Because if you look at the CAS Truckload Line Haul Index last year, we saw a 6% retraction. 2019 was not a
right, so a
year.
6% increase does not get you back to where you were.
Right.
Yeah.
So basically, they're going to claw some of that back. But they're not going to get all the way back, more than likely, to where they were. And, again, thinking about the fact that there's still so much uncertainty in the marketplace. Is this, a lot of the goods that are moving through the economy right now it's adjustment. People have been working from home. They've been, supply chains have been readjusting their inventory levels. They've been repositioning distribution centers, et cetera, to, start this adjustment process. That's going to slowly, at some point, start to
normalize
back, and they're going to start to be able to forecast demand a little bit better than they did this year, because a lot of what we're seeing right now is the fact that they did not forecast the demand for some of these goods.
Right. I mean, when you see large, sophisticated shippers who normally have extensive Q4 planning and deep sort of collaborations with their 3PLs, right. In normal times, when you see them going to these like frantic cost-plus projects to turn over inventory before peak season, like thousands of loads and stuff like that, like, clearly, like they're panicked. They're trying to buy capacity. They're trying to buy service. They don't know what consumer demand is going to be, and they're just trying to be prepared, right? And so I think, like, as you say, when demand normalizes, when people are better able to project sales and things like that, pricing will become more rational.
Yeah, these wild swings have been somewhat normal here over the last 3 years. Well, thank you so much, JP, for joining us today, and thank you so much for watching. Be sure to download the FreightWaves TV app and check us out on all the podcasts and all the freight casts, the Dooner and the Dude, all the stuff that FreightWaves has to offer for keeping you in tune with today's freight market. Have a great weekend.